Okay, so the real question is, especially after this last Wednesday, is the February market going to continue, or the Fed's in March? Well, I guess it's going to continue, but in March, February, March, are we going to see a massive impact by the Feds? So we're going to go into that, go over some of the numbers, give you some ideas of what to expect, and then as mortgage rates continue to do what they're going to do as we predict and as others are commenting right now, we will be able to get some really great metrics for you again in real time. So remember to subscribe. Remember, hey, ring the bell. This is free. This is real time. This is February 5th. We're going to go over all of the February 4th and back to give you guys some ideas of where we're at. So here's the big thing on Wednesday. All right, so the Fed's met again, and naturally, they're trying to manage, or they're trying to stifle inflation, and they have to manage that. And remember, this is super important. The Feds have nothing to do with mortgage rates, right? The Feds deal with HELOCs, home equity line of credits. They deal with car loans and credit cards and commercial lending. That is the Fed rate, okay? Now, mortgage rates are based on like a 10-year treasury, your bonds and your MBS, your mortgage-backed securities, and how they're trading out in the market. The more volatility in the market, people pull out of stocks, go into bonds, rates come down. As we start getting more stable market and a lot of consumer confidence, they pull out of bonds, they go into stocks, and rates go up. Okay, this is a ongoing, constant thing. Fannie Mae, Freddie Mac, you can watch theirs. Watch the 10-year treasury. That's a super important one to watch. But here's what's going on, right? So we actually had the federal chair. Hey, how you doing, Jado? In light of the remarkable progress we've seen over the labor market of inflation that is well above 2%, the economy no longer needs sustained high levels of monetary policy support. That's Jerome Powell. Okay, now understand, back in 2018, they did the same thing. And what ended up happening is that they did 3 or 4 different very significant increases in mortgage lending, okay, or not mortgage lending, but commercial lending. And what that ended up doing is it had a catastrophic effect. It actually slowed down the market. And then they spent almost all of 2019 recovering from that. And it was pretty bad. And if you look at some of our prior videos, you will see where we were talking about, 2018, all of a sudden you just watched the real estate market slow down as they had been raising consumer rates, and in relationship to that created some, I would consider, some stability. However, it had a negative effect because then mortgage rates started to rise, and we had gone from the mid 4s, boom, we were bumping up into the 5s again. And then in 2019, we started bringing that back down again. Late 2019, or Q4, fourth quarter 2019, we started getting down into the mid 3s, low 3s, and then all of a sudden, of course, in 2020, whoop, that things took off because that stimulated the market, and it is directly proportional. So what's going to happen? So in March, right? In March, they're talking about stepping back from buying mortgage-backed securities, which the key word is tapering. All right, so they're gonna taper. They're gonna stop buying them, is what they're gonna do. And in fact, they have their treasuries, right? And so the Feds are considering selling off some of the mortgage-backed securities, some of those bonds. And of course, the bond market, when they heard this, they absolutely did not like that, and rates became very volatile. And so that's why we've been seeing an increase in mortgage rates. As you can see, today we're at 3.75 for par pricing and 4.35 for non-owner occupied. We've been edging up and edging up. And you might remember we said at the end of the GTN, right on. At the end of the she just drew my coming back. All right. So at the end of when we took a look at January and December, we said at the end of Q1, first quarter, we're going to start to see some of this change. All right, we're going to see mortgage rates increasing and starting to bump up next to the fours. And at the end of Q3, probably into, or at the end of Q3, we're probably going to be mid fours. And that is a real number that you guys need to start looking at based on what the feds do and with the mortgage-backed securities. Okay, that's going to be super important for you to watch because that is going to relate to rate. All right, now as we get into our numbers, you might also remember that as we were going through October, November, and December, we said that the January, February, at least the first quarter of 2022, here we are, we're going to see these numbers, almost all of them, in the negative. And that's because of inventory, all right? Because when we come over here, this is awesome. This is a big number for us today. We hit 1,000. We had 1,008 on Friday, which is yesterday. Historically, it's always higher. We've only been bobbling around 500 or 600 homes on the 7-day running average. However, 1,205 still went off market. And then, of course, 664 actually closed. Now, the fact that we have more and more sellers coming online, I can tell you, yesterday, so many buyers were doing the happy dance. It's like, I got some ice cream. Why? Because we had more homes. In fact, we almost had twice as many homes that came on. It was a vast number of homes that came on the market, which is awesome. However, we still need more because at the end of the day, when we talk about active inventory, today we're at, and they'll post the chart on this, we're at about 3,100 homes. Now, understand, perspective is everything, right? Okay, we should be at 10,000 to 12,000 homes available today. Yeah, I know, right? We have 30% of it. We're at 3,000 homes, which is peanuts. Again, Canadian border down to the coast, you know, the Tri-Cities and all of that area, part of the Olympic Peninsula, and then, of course, part of Eastern Washington. It's a massive area, and that is just not enough homes. So for sellers, you've got to be, now's the time. Now's to get out there. Now's when you have a massive pent-up demand and rates are still there. Absolutely, without a doubt, if you have any questions. In fact, for those of you, here's a partial list of this week's home evaluations that we've been asked to send out. And so those folks are getting updated with actual reports. And if you want an actual report that'll give you some information, including the market update, okay, specific to your area, just let me know. We'll punch that out for you. There's no cost, there's no strings attached. It just gives you an excellent idea of home values and what's going on, what's trending in your specific neighborhood. All right. New on market, even though we're down 6.9%, it's only a couple of hundred homes. And the key thing for us to understand, we're not getting enough homes on market. Okay, so the sellers out there, look, we're not getting enough of you guys out there. That is directly proportional to pended. Pended is down because, again, there's just not enough inventory. Solds are down. This is actually, I think, like 300 homes. All right, understand, when we don't have enough homes to sell, we don't have enough homes to put under contract, we're definitely not going to have enough homes to close. So again, the numbers kind of relate to each other. It is, because it is such a small number, you know, 3,000, you know, if you have, you know, 10% of 3,000, right? It's 300 homes. I mean, that's nothing, okay? When we talk such a massive area. All right, things to watch, right? We need to watch the feds. You need to watch them as far as their volume of selling off mortgage-backed securities, because as that continues to happen, it's going to affect the bond rates, and the bond rates are directly going to affect mortgage rates, all right? March rates, you need to be mindful of what they actually do. So here's the funny thing. I swear they do it. They test the water, right? They throw out these comments. Hey, here's what we're thinking about doing, right? Like this. The committee is of a mind to raise the federal fund rates at the March meeting, assuming that the conditions are appropriate for doing so, right? Okay, so on Wednesday, mortgage-backed securities reacted very poorly to the idea of the feds selling bonds. The feds were to do this. we would expect higher home loan rates. Okay, that was the comment and that was the response. It's a given, right? Everybody likes low rates. I totally get that, okay? But there is a certain point in which the government needs to get that return. We need to find that balance where we're not basically false support of the economy because the feds are buying all the mortgage-backed securities. The economy needs to really get back on its own 2 feet, but there is a managed way. Hopefully they will not repeat 2018. That will have a catastrophic effect to the economy, will slow things down, and you could see that revisitation of a recession much sooner. So we will watch. We'll see if they learned anything in 2018. Who knows? But we shall see. Rates, they're still at 3.75. Inventory still going well. Our inventory, when I say inventory in the last 7 days, is going well, considering what we've seen the last 5 days. But if you have any questions, hey, just reach out to us. We will absolutely answer your questions within about 30 minutes. If you have anything, ask. Okay? Subscribe and share the channel if you would. Let us know what you like and what you want to hear. We do a lot of personal videos just to help people get answers in a, I would say, a deeper fashion. Anyway, in the meantime, it's a little cloudy out there. It's probably sunny for GTN out there, but because she's in Florida. But anyway, have an absolutely fabulous day. I wish you guys all the best. I'll see you on the next video. Take care.